Hello and welcome to our video on what is the stock market. In this video, we will explore the basics of the stock market and explain how it works. Section 1. What is the stock market? The stock market, also known as the equity market or share market, is a marketplace where publicly traded companies can raise funds by selling ownership shares to investors. The stock market is where investors can buy and sell shares of publicly traded companies, allowing individuals and institutions to invest in the future potential of these companies. Section 2. How does the stock market work? The stock market is made up of exchanges, such as the New York Stock Exchange, NYSE, or NASDAQ, where stocks are bought and sold by investors. Companies can either be listed on an exchange, meaning their stocks are available for public trading, or they can be privately held, meaning their shares are owned by a small group of investors. When a company decides to go public and offer shares for sale to the public, it goes through an initial public offering, IPO. During an IPO, the company sells a percentage of its ownership shares to the public for the first time. The shares are priced based on the company's perceived value, and the price can fluctuate based on supply and demand. Once the shares are available for public trading, investors can buy and sell them on the exchange. Investors can trade shares directly or through a broker, who acts as a middleman between the buyer and seller. Section 3. Why do people invest in the stock market? People invest in the stock market for a variety of reasons. One reason is the potential for capital appreciation. If a company performs well and its value increases, the value of its shares may increase as well, allowing investors to profit from the increase in value. Additionally, many companies also pay dividends to shareholders, providing a regular stream of income. Another reason people invest in the stock market is to diversify their portfolio. By investing in a variety of stocks, investors can spread their risk and potentially reduce their losses if one stock performs poorly. Section 4. Risks of investing in the stock market. While investing in the stock market can be a great way to grow wealth, there are risks involved. The value of stocks can be volatile and can fluctuate based on a variety of factors, including economic conditions, company performance, and global events. Additionally, investors can lose money if they make poor investment decisions, such as buying stocks based on emotion rather than careful analysis, or failing to diversify their portfolio. In conclusion, the stock market is a marketplace where publicly traded companies can sell ownership shares to investors. The market is made up of exchanges, where stocks are bought and sold. Investors invest in the stock market for the potential for capital appreciation, income through dividends, and to diversify their portfolio. However, investing in the stock market comes with risks, and investors should carefully consider their investment decisions to minimize their risk. Thank you for watching.